Sure, we've got Eric Wilkinson. You may recognize Eric the Wolfman Wilkinson from numerous financial networks. He's an educator at ProTrader Strategies and has been sought out by several media outlets to debate against some of the brightest minds in the industry. He is most notable for his comments in Rick Santelli's rant heard around the world.
Oh, yeah.
He was the first to use the phrase moral hazard in connection with the Fed's actions surrounding the financial crisis of 2008. So I've been looking forward to seeing you all day and hearing what you've got to talk about today, Eric.
All right there. Hey, Eric, how you doing, buddy?
Uh-oh, I think he's muted still. We have to get him unmuted.
There you go.
You got Pat and Nikki in the house. That's what I was doing.
That's what I figured.
In the house / workhouse. So
that's right. Yes, this is my home office. I'm not traveling like Kurt right now, but that is one thing I love about trading online. I was like I think you guys mentioned, I was a trader on the floor at the Chicago Board of Trade for about 20 years. And as soon as that started going online, one of the things I loved about that was trading from the computer. You can go anywhere you want, you know. One of my big things was the online trading. I was trading from the top of a mountain in Utah and literally punched in a trade right before I dropped in. So it was,
wow.
That is the fun thing about trading online for sure.
Outstanding. Well, it's great to have you with us, Eric. It's all yours, buddy. Grab the screen and go for it.
All right, great. Let me see if I can do all this myself here. So share screen. And I want to go with the rolly screen, I think. There we go, share. How's that? You're only seeing my stuff, not rolly anymore, right?
That's right, no.
All right, great. Thank you guys again for having me with you guys. It's always a pleasure. You guys throw a great event and it's a lot of fun. So, especially in person, Pat and Nikki. All right. So anyway, this is avoiding the pitfalls of trading options. I'm not going to necessarily talk about your directional assumption or my directional assumption, but what I want to do is convey to you guys is there is a way with trading options that we can increase our probabilities so we can turn that table in our favor. So we don't always necessarily have to be directionally right in order to make money on these different assumptions. So that's the key I want you guys to really take away from here. And, I do other webinars, even with Pat and Nikki, where I drill down on some of these different option strategies. Today, I want to just kind of glaze over that a little bit, and we'll talk about some of the basics in order to increase your guys' success. I did mention I traded on the floor of the Board of Trade for over 20 years. I started out trading in college with some money I'd earned, moved to Chicago, traded in the pits. So what I wanted you guys to take away from that is when I was on the floor, I wasn't able to necessarily just pick the strategy I wanted. It was like we had to take the opposite of the trade that was coming into the pit a lot of times as a market maker. So I've learned from those pitfalls, if you will, of having to stand in front of a freight train when I really knew I didn't want to. So a couple of things to get out of the way real quick. You can follow me on Twitter at Wolfman's Blog. Our parent company is at ProTrader Strat. Also, follow us on Facebook at ProTraderStrategies.com, where you can get all kinds of great free content. We're pushing stuff out all the time there. So this is avoiding the pitfalls of trading options. One of the things we do need to know before we start trading options and avoid those pitfalls is the Greeks. Now, hopefully you guys aren't all just like rushing out of the room right now. You guys are going to stick around just for a second because I'm going to make these things really easy to remember, hopefully, for you guys. Just some simple ways to keep in mind what these Greeks are and how they affect options premiums. What we want to know with Delta is it affects that option premium for a $1 move. And it's always assuming that we make a $1 move is higher, okay? So all of the Greeks are, the assumption is advancement forward, all right? Theta is 1 day goes forward, right? We got to remember that. And we can't go back in time with our DeLorean. So delta affects the option premium in relation to the underlying. So it's saying when the underlying moves $1 higher, how do we come up with that? So let me just pull up a platform here and give you guys a real quick, actually, I can do it on this one. So what we're looking at is the delta column on the calls and or the puts. Now on the call side, it's positive because I said it's an advancement forward. So if the underlying moves $1 higher, then over there in the options montage, which is just this page, we can see that our premium will increase by that 51 cents. So this goes from 296 to 297.07. Our premiums will increase by that 51 cents, all right? Vice versa over there on the put side, we can see that that's a negative. Now remember, a positive move with a negative delta, those are going to decrease by that 49 cents or whatever is correlated to it, all right? So a positive move higher. Now get those cogs moving in your brain. If it was a negative dollar move, right, a negative plus a positive makes that a positive. So if we move down $1, our put side would then be a positive delta, right? So it would add into it. And if it's a negative move over there on the call side, we could say that a negative dollar plus a negative move plus a positive delta would make that delta now negative to those premiums, all right? So it would come out of it. So delta is that first dollar move, all right? Gamma here, gamma is basically dollar number two, all right? So if we moved higher by $2, okay? Or dollar number two. So gamma just goes with delta. So if you're ever wondering what gamma is, it just goes with delta, and it's an add-on. So when you're just looking at these option premium, you're kind of looking at your status on your what would happen, you know, the theory of what could happen here is now on that second dollar moves, you can see the gamma here. Gamma goes with delta on the second dollar move. So that second dollar, the first dollar move we could see here. Oops, I don't want to do that one. Sorry, I clicked on the wrong thing. I want to get this capture for my marker here. So we talked about this on the first dollar move higher. So we went from 296 to 297, right? 07. Our premiums over here on the call side would have increased by 51 cents. So we would have then been looking at 261, right? And then on the offer, we've got 51 cents going in there. So it's 21. Okay. So that's what our premiums would have been after that first dollar move. Now, second dollar move, gamma goes with delta. So now if the underlying was trading at 298.07, right? Now we have 52 cents adding into here. So the premiums on that second one would be 212, right? I'm doing this off the top of my head, so please bear with me, or 2173. Okay, so gamma just goes with delta on that second dollar move. Pretty simple. You know, the Greeks, they want to try and make them hard. As a matter of fact, I got your Greek symbols over here. Vega isn't even a real Greek. I stole this as a lowercase gamma number. But delta is data. Gamma just goes with delta. Goes with delta, right? Now theta is the thief in the night. All right, that's what we used to say, because overnight that theta thief comes in and picks away at our premium. He comes and steals a premium every night. Well, sometimes you want that to happen. Sometimes you want theta, that thief in the night, to come and steal your premium. So theta, we can look at it, is this little premium right here. You can see that closer to expiration, 16 days to 44 days, theta is a little less aggressive. So the further out in time we go, theta doesn't even really know you exist, really. You can think of it that way. But the closer it gets to expiration, theta's trying to take as much money as he can, all right? So theta, that thief in the night that comes and steals your premium, sometimes you want him to, right? You know, you've heard sell high, buy low. Well, the same thing goes with Greeks, all right? Theta being a thief in the night, well, if he's stealing a lot from you, do you want to be buying? No, you want to be selling. So theta, if you're thinking about, you know, selling options premium, or you're leaning towards selling a call spread, selling a put spread, or any of those types of strategies where you collect a credit, well, think about it. You collect a credit, that means you sold high, and that thief comes in and just steals that premium, gobbles it away. Well, then you get to buy it low, even if the underlying trades sideways, right? You were directionally wrong in that case. Well, theta, that thief in the night, is coming and stealing your premium. He's helping you out. All right. So we aren't always right on our directional assumptions. We all know what assumptions are, right? Well, at the end of the day, what we want to do here with trading options is turn the tables into our favor. And this is one of those ways. So if you are leaning towards selling premium, you want theta to really be ramping up. So we always talk about as close to 35 days to expiration as we can get is where we would be selling premium in these different strategies. All right. Well, 44 days is probably the closest days to expiration on to 35 days. So this, what happens is we see theta, you know, he starts kind of eating away at your premium, and then it starts really ramping up, right? And inside of 35 days to expirations, when that starts happening, all right, days to expiration, we really start seeing our premiums deplete. Well, if you're selling them, you want to take advantage of that. When you're buying them, you want to limit it, and you want to get out here, you know, somewhere in the 80 plus days to expiration. What I like to say is that's where you're buying premium, selling premium. You want to get real close to that thief in the night. You want to cozy up to him, right? All right. So, and theta, like I said, less aggressive further away, more aggressive near. Well, Vega is just the opposite. Vega is more aggressive further out the time horizon and a little bit less impactful closer to expiration. So Vega will spike further out in time and you know, contract rather quickly when that volatility comes in. And we'll talk about how that really comes to fruition here in just a second. I'll pull up the chart and everything else and show you guys some other interesting tidbits to it. So we can see the Vega now we're on. You can see it's a little bit less closer to expiration as in comparison to further away. But, you know, on the flip side, theta isn't as aggressive far out in time. So what we're talking about with volatility is this number right here, Vega. It's basically implied volatility. They just call it Vega probably because it's a V. All right, so this is talking about for 1 percentage point move. All right, so we've got 1 percentage point move. Let's say it's a positive because we're talking about advancement, right? So if this increased by 1 percentage point from 55.92 to 56.92, just to keep it exact, right? We got 1 full percentage point there. This volatility would then add into, oops, sorry, I hit my other button, add into the premium. So 1 percentage point increase, we would get a quarter going into this. So then we would see this puts being $13 even and $13.35, right? Okay, so you can see on both sides that Vega is positive, right? Because it's an advancement. If volatility goes up, all premiums go up. It's, you know, this isn't the VIX that we're talking about, although the VIX is compiles all of the volatility around each individual underlying. We want to really narrow down our search to what is volatility for this specific underlying, because volatility for Alibaba isn't the same as volatility for Procter and Gamble. All right. So what we need to do is, you know, split out all of the noise and really kind of drill down on this specific underlying to know where is volatility high right now. Well, I'm not saying go look over at the VIX and see volatility is pretty high for the VIX, or, you know, we're in the 20s or 30s in the VIX. No, what I want you to do is volatility isn't really created equal. We need to look at this specific underlying and see whether those premiums are expensive, right? Because if volatility is high, we know those premiums are expensive. If volatility is really low for BABA, well, we know those premiums are super cheap. So that's kind of what starts getting those cogs going again, right? It's that if they're really cheap, what are we going to do? That's where we would be buying options. And if they're super expensive, well, that's when we're going to be looking to sell those options. So just all of this is really just to get your guys' minds kind of working there, thinking a little bit ahead. When do we sell options? When do we buy them? It's not just picking something out of the hat and watching TV. And I have friends, believe me, on mainstream media, and they're always talking about going and buying calls or, buying puts for their directional assumption. And it blows my mind, and these guys were floor traders too. But you have to know that they have to take everybody's risk parameters into account, and they don't know if somebody has a high risk tolerance, low risk tolerance. So a lot of those things, the people above that are writing the rules and telling us whether we're doing things right or wrong, SEC, they're the ones that say you can't really give that kind of investment advice, all right? So they just talk about their directional assumptions and then talk about a option strategy. Well, it's not always the right option strategy for that environment or what's going on around that specific underlying. So I kind of already got ahead of myself. I just start talking to the camera, I guess. All right, volatility, we buy low, sell high. I mean, that's pretty obvious, right? Whenever you're doing anything, you want to buy low and sell high. And we talked about this. Volatility is one of the biggest components of options pricing, in that it's the one that is going to fluctuate at any given time, right? We know delta is the one that just kind of clicks away for every dollar move. So we can see a dollar move higher or a dollar move lower. Well, we know what delta is going to do to those premiums, all right? We also know that every day goes by. So we know that that thief in the night just kind of clicks away at our premiums. Well, what we don't know is how volatility is going to kind of move back and forth. Do we? Well, maybe. Yeah, I think sometimes we can see when volatility for itself, it's just like a chart. If you look at a chart, you can see with your Fibonacci's, it bumps up against the Fibonacci resistance and, kind of pops down against another support level, all of those things. Well, I'm going to show you on some, I might as well just pull it up since I'm talking about it, right? I mean, why not show it? So let's just look at, we're talking about BABA. So for lack of a better example, let's just go with BABA. We can see here now, yes. All right, we got a massive spike there. That was the whole Corona thing. But keep in mind, these kind of spikes, like we saw, if I pulled up a chart of the VIX, which I guess I can since we're talking about it, the spike in the VIX, I always look at the VIX because I like to see where it's going. This kind of spike in the VIX, we haven't seen since 1987 or something like that. Even a bigger spike than what we saw back in 2008, 2009. So, one could say that this is a black swan event. When's the next time we're going to see this? Maybe another 10 years. I don't know. I can't answer that for you. But I do know that that is a major spike that we may need to take out of the data point at some point in time or let it roll off. But for this example, I'm going to leave it in there because we aren't out of the woods yet with this whole thing. Maybe it mutates or who knows what happens. I'm not one to predict that. But what we can say is that you can see that it has a tendency when it gets down at these levels, 23, 26 or whatever, that's pretty low, all right? And that it has a tendency to want to come back to about this mid area, right? Yes, last year that would have been a high, but I would tend to believe we have higher volatility going forward for probably the rest of 2020. So, and that's my assumption. You guys have to decide for yourself, but I'm just a talking head, right? I would say volatility is here for a little while, but having said that, do I think that we're going to see this much unknown in the market for BABA? I think that that's probably a little out of the question, but just to say it could be in there. We can see that there is a point of where it wants to slow down on that volatility, but when that volatility comes out, it really comes out, right? We could say that just from the last couple of spikes in here, it spiked up to 51 or whatever and then dropped down to 41. That's 10 percentage points. All right, so when we were looking at that volatility coefficient over here in BABA, 10 percentage points for this volatility, well, what's 10 times 40? That's $4, right? $4 for that, just that 10 percentage point drop in volatility. And if we looked at that chart, like it literally, it just traded pretty much sideways, right? I mean, a $4 out of that premium, I mean, I would have had to have a pretty big move in BABA. So the idea here is we want to be able to take advantage of that. You know, if I had a bullish trade on or something like that, and I had $4 come out of my premiums, I'd bought calls, well, that would have really hurt. One thing, you got the direction a little bit wrong. And when you're buying premium, you got the theta coming in and eating your premiums, you got the volatility coming out. All of those things are against you. You could have even been directionally right. And if that volatility came out and that theta came out because you picked the wrong month, well, all of those things being said, that could have really hurt your position, right? Say, for instance, I bought calls right here. I could probably do the math on it. I got the directionality right, but if I had picked the wrong month, the wrong duration, and that got that volatility wrong, that could have completely offset my gains on my, you know, directional assumption being correctly. Like somebody said, hey, you know, this is a buying opportunity, and I bought into that. That I could have lost money. So what we try to do is when we have our assumption, whether it's bullish or bearish, we go through some guidelines for you guys in order to determine what is the optimal option strategy for that assumption. So we're going to look at these internals like volatility, determine whether that's one of the main components. Like I mentioned already, volatility is the major component of option pricing. That is a fact. Yeah, theta's in there, but that's the unknown that we got to figure out is, all right, is this right now at 54 high or low? And we can't just, one thing I want to mention is we can't just pick 54 as being high or low, because I could go over to like Tesla and look at Tesla. Like, does Tesla ever even get below 51? Well, we could say in the new world, it doesn't. 62 is the low, right? And that's still Vega. If I go over to here, that's still Vega, all right? So we need, that's one of those, back to what I was talking about earlier, is we need to kind of discern where Vega is in relation to where it's been in the past for this specific underlying, all right? You know, I mean, Pepsi rarely gets up into those 50s. You can see, yes, it did back here during that whole Corona thing, but, you know, for the most part, to get up above 50 is a real struggle, especially before the new world order of volatility. But right now, you know, in the 20s, yeah, it is where it's at. So now we could look at MGM being in the 74s, right? So we have to know where MGM has its volatility now in relation to where it's been in the past. Now, how do we determine that? We determine that by, well, I've got ahead of myself again. Volatility, I talked about this earlier. This is how far ahead I got when I was chatting with you guys. Big as the change in the option pricing for 1% point change, right? Just to reiterate that. So we saw that for BABA, that 10-point decrease, right? 10 percentage point decrease, that starts really adding up. 1 percentage point is almost nothing. As a matter of fact, to go back to that almost nothing move for BABA, we could see that it probably changed from yesterday to today. Basically, this is yesterday's implied volatility, right? It was 50, it moved up 4 percentage points, you know, and for that 40 cents, let's call it, that's $1.60, right? So premiums, despite whether or not you were picking the directionality right between yesterday and today, where it didn't really end up going anywhere, premiums increased in BABA by $1.60, all right? That's a pretty good amount, you know, for it really closing only $2 lower, right? So we can take advantage of that, that volatility expansion and contraction, which is really where we want to go with this stuff. Oh, I changed the slide underneath. All right, so knowing when volatility is high or low for an underlying is paramount because that's going to determine whether we're buying or selling. Now, this is one of those talking heads, and I don't necessarily want to throw this guy's specific name under the bus, but, and this is a really old article. I'm not trying to just cherry pick, but they do bring this guy back around earnings quite often. But this guy is basically saying, go out there and buy calls across the board for earnings. Now, one thing to know is when we have earnings, that is one of the times we understand volatility is at its highest, is almost before every earnings call we have volatility really expand because that's the unknown. Keep in mind, volatility really is a fear indicator, as much as people don't really say it is. It can be a fear indicator from buying calls, right? If people are buying calls left and right, they've got FOMO, fear of missing out on the upside. So that spikes volatility. It's a product of people buying premium, and those premiums uptick, more buyers than sellers. So missing out on the upside FOMO is as real as fear of protecting my gains and worrying about the downside. So we get volatility spikes on rallies and pullbacks, no matter what. So what we do know is heading into an earnings, we do get those volatility spikes happen. And then after the news is out, that volatility crushes. So to go out and just say, hey, this is my favorite option strategy is buy calls before a data point. I've showed in several different webinars that volatility comes out dramatically after that event happens. So we can see volatility crush happen right here after that event. We can see the volatility really comes out after that event, heading into, it's hard to say right now with the corona, but we can see volatility after the earnings. We start getting that volatility down slot. Well, if I mentioned, if you bought those calls, even if you're directionally right, you can see that money really evaporate quickly. And you're fighting an uphill battle. I mean, wouldn't you rather roll that snowball downhill? All right. Also, Rolly, if you see any questions popping up as I'm going along, I've got my little questions and answers thing over here, but I think I've got the wrong one up. All right. So this is how we determine whether implied volatility is high or low. And you guys can easily write this down. I also have script for TD Ameritrade Thinkorswim platform that really just runs this through to the exact number. You can look at that chart that I have for implied volatility and kind of figure out this whole implied volatility percent. And all this really tells us is where is current implied volatility in relation to the high and the low. So what we want to do is determine through this math problem, is it at the higher end or is it at the lower end, right? So what we can do is current IV minus low IV, high IV minus the low IV. So let's go back to this implied volatility of BABA, and we can see, I can't do a straight line. All right. Arrow options. Let's see if I can do an arrow real quick. All right, never mind. I'm just going to do a line. All right, so we can see right here, this line basically lines up right here. I'm going to call this 73, and I believe from checking it was 73, all right, or 0.73, all right? And I'm talking about percentages, so, we know that when you're talking percentages, you just multiply it by 100, right? And that's how you get your percent. And the low down here, if we drew that line, that's right around 23. 23 ... All right, I'm going to chop it off. I'm not going to round up or round down. I'm just kind of trying to make math easy here. So what did I say? It was the current IV, right? Current IV minus the low IV, and I'm not going to write it all out for you guys, but you guys get it. Current IV minus the low IV, high IV minus the low IV. Because you can see what I'm doing here. I'm just getting the range right here. That's the range between the high and the low. and the current where it currently is in relation to that low as well. So current IV I said was 55 minus the low, which is 23, right? And then the high is, what did I say, was 73 minus the low, which is 23. All right, we got to make those sums, right? So now we've got 32 divided by 50. Well, that equals 64%. All right. So it's in the 64 percentile, and that's even taking in this huge spike up here. All right. We don't always know. Now, sometimes keep in mind, if it was up there at 73, you know, just like back here in the day, you know, that was a pretty high implied volatility for BABA. It doesn't mean that once it's at an elevated level, it's always going to go, you know, straight down. Sometimes it does uptick. So you could have it at 100 percentile, right? And if it upticks again, you're still at 100 percentile. That's one of the problems with this equation, but nothing is perfect. Just like if it was at its low and it downticked, well, it's at its lowest level now. That's something we can't avoid. One thing we do know, though, is that once it gets down there, like it did, you know, it never really got below this level, but of course it did downtick a little bit, albeit those incremental down moves are going to be much less. All right. We're not getting 10 percentage point drops below those lows that we see kind of like here. You know, this is kind of the area where I would think that it's not going to go much below. As a matter of fact, I would think the area where it's probably not going to go much higher than that is probably 60 would be my thing. So 5 percentage points higher is where the extreme level in my eyes would kind of be for this particular underline. And that's
hey, Eric, just a real quick question is coming on this. I want to make sure we don't lose this one. We've got a fellow that wrote in and says that he does linear regression channel on IV for 50 days. What do you think about that?